Hello students, welcome to this video on income from house property under the Income Tax Act 1961. In this video, let's see how income from house property is being calculated. First, we must know what is the basis of charge. Under section 22, it says the essential condition is the property must consist of any building, flat, commercial space or surrounding land, and the assessee must be the legal owner or deemed owner under section 27 during the previous year. And the exemptions are the owner must not use the property for running their own commercial business or taxable trade. The income from house property is been categorized into three categories. First one, self-occupied property. Second one is let out property, and third one is known as deemed to be let out property. For computing the income from house property, we must first know what is the gross annual value. To calculate the gross annual value, we must determine what is the expected rent or the municipal rent or the fair rent, but it cannot exceed the standard rent fixed under the Rent Control Act. Point number 2, we must compare with actual rent received, and third one is if there is any vacancy or loss or there is a period of vacancy, it must be considered. The deductions of municipal taxes are given for this condition, where taxes must be paid or bond actually paid by the property owner and not by the tenant. To calculate the net annual method, we use this formula. The formula is NAV is equal to GAV minus municipal taxes paid, which means net annual value minus is equal to gross annual value minus the municipal taxes paid during the previous year. And the standard deductions are under section 24A, which means for assets there is depreciation, but for this they don't give any depreciation. Instead of that, they give 30% of NAV value as standard deductions. And the section 24B says interest on loan, which is any amount allotted or loans borrowed for the acquisition, construction, repair, renewal or reconstruction of the house property is also allowable. The interest deductions under the capital for self-occupied property is in the new tax regime. The capital stand as there is no need for any deductions allowed. And you must also understand that the unrealized rent and arrears is also to be calculated under section 25A, where arrears or rent received or unrealized rent recovery subsequently are taxable in the year of receipt, even if the assessee is no longer the owner. Under section 26, it says co-owned property, which is if a property is owned by multiple co-owners whose shares are definite and assessable, they are not taxed as an association of persons. Instead, it is considered as individual taxation. And in section 27, there is a term deemed ownership, which means transferred without adequate consideration or a transfer from minor without any consideration. So the computation workflow stays: first step, we must find out what is the GAV, that is gross annual value, and next we must find out what is the net annual value during the taxes paid and deduct the municipal taxes paid during the year by the owner. And the third step is deduct the standard deduction of 30% under section 24A. And the fourth step is to deduct interest on borrowed capital under section 24B to get the final net taxable income. So this is how we calculate the income from house property. Thank you.